Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is Michael Becker.
Hey, Paul.
Michael is also with Old Capital. So today in the podcast, we have Darwin German. So Darwin and his group own several multifamily properties in the Dallas-Fort Worth area. I thought we'd kind of meet Darwin and kind of figure out a little bit about his story, his background, how he got into the multifamily business, and then he'll talk a little bit about some of the transactions that he's closed and how he went from here to there. So that's a little bit about what we want to talk about today. So everybody, meet Darwin. Darwin, meet everybody.
Hello, everybody.
So Darwin, tell me a little bit about yourself. You live right now in the Dallas-Fort Worth area, but where did you grow up?
I actually grew up just outside of Los Angeles, and my dad was an auto mechanic.
Okay.
And he also invested in small properties, things like that. And his hobby was work. So every weekend he had me up working on apartments and make-readies and things like that. And grew up in that industry.
So how did you get from Los Angeles to Dallas, and what year did you guys come here?
Actually, my father had a property that he had sold and wanted to do a 1031 exchange. And he couldn't find anything in California that made sense. And he ended up finding a property in 1989 in Duncanville, Texas, and did a 1031 exchange and bought that, 128 units. And so then we would come out here, we would fly out, work on the property, same MO, always have to be working on the property. And in 1990, we had a family friend who referred us over to a group that just sold a savings and loan. And they had a lot of money to invest. And they said, where should we invest? And asked my dad that. And he said, oh, you got to buy in Dallas-Fort Worth. And they said, oh, what do you know? You're just some small town broker. And they went to their big time advisor, Goldman Sachs at the time, and said, oh, the most undervalued real estate's in Dallas-Fort Worth. They said, hey, you know what you're talking about. Here's $20 million. Go invest that. That went good. Hey, here's another 20.
$20 million as a chunk.
As a first chunk. And we ended up buying $120 million in real estate, all cash, over 5 years, 5,500 units, primarily in DFW, but also in Phoenix and in Seattle, Washington.
So how many units again?
5,500 units.
So you guys went from zero in Texas to 5,500 units doing. Did you guys have ownership, or you just did third-party property management?
Ours was all third-party, every bit of it. But we acted as an asset manager.
Okay.
There was an asset manager that oversaw us, but we treated it just like our own money. And so as far as identifying the properties, we did the identification, we did the due diligence, we did everything. Most of the time, they didn't even see the properties. They just said, okay, go ahead and go.
But they collected the checks.
They got the checks, absolutely. They made the big money, absolutely.
So your dad got you into the business, and that was in 1989, 1990. Let's fast forward to today. Tell us a little bit about what you do.
Well, I'm going to digress slightly to transfer into that side of it. I actually moved out in 1991 to identify the properties, do the due diligence, ended up going through and taking over the management company by about 1995. We had 150 employees, and I ran that operation. So I got a lot of experience in taking care of those properties through that group, and that was just an absolute blessing. And in 2001, we sold that portfolio and went from 150 employees to 5 because we were thinking we were at the top of the market, didn't realize there was a ridiculous bubble coming. And so then I just started buying my own deals, a lot of office warehouse, industrial, some multifamily. And in 2008, we finally had the crash, and I said, okay, now's the time to buy again. And so we started buying again in 2008.
So how would you describe today on what you're buying? Are you a value-added? Are you a stabilized? Are you kind of a hybrid between both value-added and stabilized? I mean, can I put you into a bucket, or can I put you into all the buckets?
Oh, well, I'm not a one-trick pony. I can do a lot of different types of properties. However, I do specialize in apartments. and I like the value add component and anything that makes sense. We are looking at a couple of yield deals, but I like the value add because you can turn the money quicker.
So you have owner control, several thousand apartment doors here in the Dallas-Fort Worth area. I thought what we would do is maybe focus in on 3 properties, and let me see if I can name the 3 properties that you own and your group owns. One is called Villa Creek. That's over in Dallas.
Correct.
Another property is a fractured condo in Irving. And the third one I thought we'd talk about is a little bit about Park Row, and that is over in Arlington.
Correct.
Okay. So let's talk about the first one in that Villa Creek property. So you recently just purchased that property?
Right.
When did you guys close?
We just closed on it about 3 weeks ago.
All right. How many units was that property?
161 units.
Okay. And so how did you find Villa Creek? How was the transaction brought to you?
That's actually pretty much an interesting story. There's a lot of people chasing a lot of deals right now. Mm-hmm. And being a broker here for 25 years, I know most of the players and I've got a good reputation with them. So they always bring things to me. And this particular property came on the market and it's got frontage on 635. And a broker told me about it and I said, I love it. I want to buy it. And we started talking about the ownership, and the owner lived in Denver. So I actually flew to Denver to go ahead and meet him face to face. So we presented an offer, and then I flew out there basically to follow up on that offer and get face to face. So he knew who I was, and that's a better way of getting your deal accepted.
So you made a financial commitment to jump on an airplane, fly all the way from Dallas to Denver, actually meet with the seller. And how big of an impact did that have by you going out to Denver?
I think it made all the difference in the world. He knew who I was. We could talk about it. He can look me in the eye, shake hands, and we can talk about exactly what it is.
And why was he selling? Because that's always the question that I always ask, in these transactions is, how long did he own the property? Why is he selling it? Is there something functionally wrong with the property? So I'm going to go back why was he selling it?
All of the above. This was his last asset in Texas,
okay,
and he had sold everything else he had. So he wanted to sell that. The property needed a lot of work. He was having problems with it. In my opinion, he was not a good operator in the fact that everything was kind of short-sighted on his repairs. I like to take a long-term approach to every repair and improvement we do and correct it right, do it right the first time because I plan on owning long-term. So he had a lot of deferred and a lot of problems with the property. So he kind of needed to sell it.
Yeah, so the property needed a lot more money thrown at it to fix some problems on the property. So he bought the property probably about 3.5 years ago. He did a Fannie Mae loan on the property thinking he was going to keep it for a long period of time. I would think within probably about 2 or 3 or 4 months after he bought the property, he realized, living up in Denver, he didn't have the best information, but I think he realized that when he bought the property, 3 months later, the Texas Department of Transportation decided that they wanted to expand LBJ Freeway. And with the expansion of LBJ Freeway, which is a major freeway that goes through North Texas, it's a major highway, this property sided the freeway. And because of that, traffic patterns were all thrown off. A lot of the dust, a lot of the tenants didn't want to put up with any of the problems when you have a freeway expansion and cars going in and out. And that lasted for, about 3 years, 2 years or so that the LBJ was under construction. And occupancy fell, and he didn't put money into the deal, so he really needed somebody to come in, wearing a white hat like you, and throwing fresh equity into the property and fix some of the deferred maintenance. And since it was his only asset here in Texas, it really was out of sight, out of mind. And so when Darwin came in, it was an opportunity for him to say goodbye and a good asset in terms of location to buy. Would you agree?
Oh, spectacular location. Located right there on 635. One of the things that we liked about it is there's vacant land right next to it that land is going for $40 a foot just for the dirt. And our property, if you take everything we have into it, we're only paying $20 a foot just for the dirt with apartments on them. But to add to his problems, between January 1 and when we closed, he racked up $65,000 in fines from the city.
Ouch.
Yeah, so he was not doing well, and we got to come in there and, on the white horse and come in there and really make the city happy.
So tell us a little bit about we talked about deferred maintenance. Tell us a little bit about the physical issues with the property.
It has every problem that you could have. We had a boiler that was not running, underwater hot water leaks.
So you're telling me no hot water in the property?
No hot water actually very limited hot water on the property.
Wow.
That was the biggest part of his fines.
Yep.
So it needed a boiler. There was no signage on the property. You couldn't even identify what property it was. It needs a refacing of everything. He did such poor workmanship that when the patio rails were bad, he just went ahead and screwed plywood up over the patios. Okay, so just to give an idea on how cheesy that whole thing is.
So how much money are you going to have to spend to rehab the property?
We've got budgeted $1,650,000, $1,650,000.
Where is that mostly going to go to?
The single biggest line item is interior improvements because we want to change the demographic and we're looking for a rent lift on that property. And in doing so, we have to take care of all the outside, but we also have to update the interiors.
And so one of the things that we're seeing quite a bit, what a lot of the banks are asking for, is windows. This property was built in
65 and 68.
And it still had the original windows on the property. So it was mostly the bank that was requesting for you guys to put more efficient windows on the property because these were the original windows on the property. And that was going to be a price too, that it was really going to clean up the property by putting in better windows to the property.
Exactly. Originally, I did not want to replace the windows, and they are single pane, not energy efficient at all. However, we generally put up solar screens over every window to dress it up and to help on the utilities. And I didn't want to spend the massive amount of money it's going to take to do that because one of our exit strategies is the possibility in 3 to 5 years that there's a possibility that this land is available to be torn down and build 5-story property there, apartment property, with about 300 units overlooking downtown Dallas. So I did not want to go extreme on the improvements, but the bank saw that and said, okay, we want all the windows replaced.
So that was a challenge that you're working through right now. So talk a little bit about structure of the transaction itself. What type of a loan structure did you guys put together?
We actually got a bank loan, and they did 75% loan to the purchase price, and then they also financed 100% of the rehab.
So 100% of the rehab, 75% of the acquisition price plus the rehab into the deal itself.
Correct.
You got it as a non-recourse.
Non-recourse loan, correct.
Okay.
And they also added a little bump in there because the valuation after rehab that they have, they went ahead and put in there that as soon as we get stabilized, they'll go ahead and give us another $500,000, which is about equivalent to what I was going to get if I refied the property, which won't cost me anything.
Yeah. So in the loan documents themselves, that if they want to get a supplemental, it's called having the ability to get good news dollars out of the transaction. So if you do well, after the property gets stabilized, let's say it may take 6 months, may take a year, may take 18 months to get a stabilized NOI number, is that they tell you up front how much money, if you hit that mark, how much money that they will give you without refinancing. It's a modification loan. They extend out, they put more money over to you. And so that's a good way of doing things. So one of the things that I wanted to have Mike ask is about the fractured condos.
Yeah, so you bought a fractured condo deal in Irving as well. So maybe tell a little bit about that and maybe discuss kind of how that process went down relative to owning 100% of an apartment complex. So just so before we get into what a fractured condo is when you have a condominium complex and say it's 100 units and you only own 90 of them. They call it a fractured condo because you have fractional ownership with different people. So maybe talk about that deal a little bit and how you found it and kind of how you put that deal together.
Well, this deal came on the market. It actually went through a couple brokers, I believe, before it finally settled on the last one. And in and out of contract a couple times because fractured condos, they're a unique beast.
Yeah,
absolutely.
Yeah.
So when this finally came to me, we had put in an offer beforehand and it was lower than they wanted, but they ended up coming back around to us so that we could buy that. Now, it's unusual, but in 1991, I actually bought another fractured condo deal in Las Colinas, and work through that deal. And so I have some experience in the fractured condo side of it. This property in Irving is 64 units, and we bought 52 of the 64 units.
Gotcha.
The other 12 units were occupied and owned by other people, individuals. And basically, we went in there and made them an offer. And over time, about 6-7 months, we went through and bought those other 12 units so that we can have the whole property. Now it's back to an apartment property. We got rid of the HOA. It's going to save us money on that. And we own 100% of them.
That's great. So during the transition, what were some of the challenges? So like if someone's out there looking at potentially doing a fractured condo deal, what's some of the operational challenges on that versus, say, a regular apartment complex? What are some things you experienced?
Well, first off, on the purchase side, it's harder to get debt on it. We set up with a private lender that could handle doing the original purchase loan and then all of the individual loans as we purchased those properties, and then they rolled it all into one.
Gotcha.
So we're looking at going through and doing a refi now into a Fannie Mae loan after 12 months so that we can get a little cash out on that as well. Operationally, you have to have two sets of books because you have the property that we own, but then you also have a homeowners association. So you have to juggle what is homeowners' dues, what the homeowners pay, and do an accounting of all that back and forth, which is just
Nightmare, right?
it's just a nightmare.
Yeah. So any idea, what kind of value you think you created just by the simple fact that you're able to own all of them versus 52?
Well, it dramatically increased the marketability of it.
Sure.
So it's no longer a fractured condo deal, it's an apartment deal. The exact amount that I can attribute to taking it from fractured condos to apartments, I can't really say, but we are we're doing the same thing. We improved the property, gave it a whole new personality. And an additional side note on that, it's actually got an extra 3 acres that we're going to build on. We can build another 60 units, where a 64-unit property is pretty inefficient to run. So our expenses are higher because of that. So as soon as we build the other 60 units, not only do we have a possibility of a rent lift because of new product with it, we also have economies of scale that will allow us to reduce our expenses on the 64 units that we have and increase the value just because of that.
So you went in there, and since you didn't control all the units, but you did control the HOA, so you had to put pressure on, or you greatly encouraged the individual owners that owned those condos to play ball with you?
Okay, yeah, you're setting me up to be a bad guy, but I'll fall for your trap there. The first fractured condo deal I did, I went in there and played nice and ended up getting kicked in the teeth. So this time I came in there and said, I have the bat, I'm going to use it. So the property needed a lot of work. It needed about $4,000 or $5,000 a door in CapEx. Well, that exterior CapEx of, let's just say $5,000 a unit, that is spread out over every unit. So I went in there and said, good news, guys, we are improving the community. We're going to be doing this. By the way, there's a $5,000 special assessment that everybody has to pay. Mm-hmm. So either you give us $5,000 for your unit or we'll buy yours for X.
Right.
So it kind of motivated them to sell.
Right. That's the problem with the fractured condo. When you don't have control of it, then things deteriorate and the community goes downhill. So
yeah. So you have to dissolve the HOA because now you own and control the 100% of the units, and then it goes
Correct.
from being a fractured condominium to a 100% apartment building.
Yeah.
Correct.
That's good. Maybe move on to another property you guys own. You bought a deal in Arlington called Park Row Apartments about a year and a half ago or so. Is that right?
Yeah, just a little, about a year and a half ago.
Maybe tell us a little bit about, how big the deal was, some of the challenges with the transaction, kind of where you've taken it from to where it is today and some of the stuff along the way.
Well, Park Row is an apartment in Arlington. It's 205 units. And this property came on the market. And as soon as it came on the market, I had talked to the broker about it. Within 30 minutes of it being on the market, I was on the property, looked at it, said, yes, I'll take it, and had a letter of intent in an hour and a half later. The seller had negotiated with their lender because they had a prepayment penalty, but they had to sell it, that they negotiated a discount on that prepayment penalty, so they had to close by a certain date. So they wanted to get it under contract as soon as possible with somebody who would close.
Right.
And that was me. So I got it under contract, and it did have deferred maintenance. It had one of the worst roofs I've ever seen in my life on it. So the roof had to be completely replaced. That was an $800,000 job alone.
Wow.
And it needed a lot of rehab. And we budgeted all that in there, and we start going through to get our loan. And a completely different mortgage broker, I will go ahead and put that in here. We had it set up because one of our partners wanted to use this other guy.
Sure.
And against my instinct, we went ahead and went with them. They came through, and their loan documents were so ridiculous. First off, it was full recourse.
Right.
They had every single thing in there that was detrimental. They even had a waiver of homestead rights
Okay.
in their loan documents to do that, which is the only, we even said, that's not even possible. You can't waive your homestead rights in Texas. And they said, well, we have it in there just in case they ever change the laws.
Right. Yeah.
And this was a bridge loan we were only going to have for a year.
Yeah.
And we were negotiating those loan documents, negotiating them. Finally, a week before closing, they said, forget it, we're not going to do the deal. A week before closing.
Sure.
Okay, so I did what I normally do, and I went crawling back to Paul and saying, Paul, help. And so he actually set up a loan that we got in 1 week for $5.8 million to go ahead and get the deal closed. And then 1 year and a month later, so 13 months later, we refinanced that note, gave our investors 55% of their original cash back.
Right.
And it's cash flowing like a big dog.
Put a Fannie Mae loan on it.
Fannie Mae loan, yes.
So, Paul, if I want $5.8 million in a week, you got a solution for me every time, huh?
I don't think so. Only for special people.
That's good. That's good. So, how many investors do you have in that deal? You have a bunch
We have about 35 investors in that deal.
Wow, that's great. So, is that typically how you do deals when you're out there raising capital? Do you do it in a syndicated model, or do you joint venture with one guy, or kind of how's your typical structure? If you work with Darwin, what do you typically do?
Typically, we do syndicate the deals. We raise the money from individual investors. It's funny, our average investor has only put $72,000 into each deal.
Got it.
On average. And even if they come to me with more money, I say, let's spread it out over a couple more properties. And we've got about 300 investors now.
Oh, wow.
And it's a solid deal. We put together a private placement memorandum, follow SEC guidelines, raise the cash, and purchase the property.
All right, before we go on to other stuff, can we throw one more property into the mix?
Okay.
You guys are buying a property in Hawaii.
Yes, we are.
Why?
Why? Well, first off, why wouldn't you want to own property in Hawaii? We actually found a place on Maui. We looked for about 8 months. And in Maui, only 3.4% of the real estate is owned fee simple. 3.4%.
All of them has, 99-year leases?
They have long-term leases. They have all sorts of different structures.
So fee simple is when you actually own the real estate and the improvements on it versus being on a ground lease where someone else owns the land.
Correct.
And just own the improvements.
Correct. So that's one big advantage. The other is you can't find apartments at all there because they always convert them to condominiums and raise the value of those by selling them off individually. Condominiums or timeshares, something along those lines. We found this property. It's only 10 units, but it's still about $200,000 per unit. But the rents are 45% below market.
Wow. Now, how did you find that one, living in Dallas and that property being in Maui?
Well, I traveled over there a few times. We were looking and had a broker there looking and scouring the market for me and sending me everything. And no, that's not good. No, that's not good. When we finally found one, the whole idea is you got to tie it up so you can really see what's in there. So we negotiated a contract. And every time I've ever put any property under contract, I analyze the numbers. And as we analyze more and more and more, the deal gets better and better and better. For example, on this property, rents are 45% below market. And most of the units have already been fully improved with granite countertops, black appliances, wood floors. But the biggest thing on this one is solar power. You can add solar power to the property, and that's going to net us about $2,000 a month by putting solar on the property.
So instead of paying $8,000 or $9,000, whatever that number comes out to be for electricity, you're actually going to gain $2,000 back by selling it back to the grid?
No, we sell it back to our residents.
Okay.
And then we do have to augment it just in case of cloudy, nighttime, whatever else it is. But we sell that back to them. Now, Hawaii has the highest electric rates in the country at about 36 cents a kilowatt hour.
Wow.
And what's that on an apartment complex in Dallas? What are you paying on Villa Creek, for example?
Well, on an all bills paid property where we're paying that, it's about 6 cents.
Okay. So 6 times.
6 times, exactly.
All right. So what's the play on 10 units in Maui? And by the way, Mike, note to self, let's see if we can find a 10 unit in Kauai.
Yes, absolutely. The play on this one is the same model. I use the same model, the 5 R's is what I call it. You recapitalize a property, you rehab it, you reposition it, you refinance it, and then you repeat it. And that way your money comes out mostly tax-free, and you can turn the money faster. Well, in this particular instance, we're getting a Fannie Mae loan on our purchase of this property. And after we add the value with the solar power, raising the rents, and doing everything like that, we're going to be refinancing that property, and we're projecting 60% cash back to our investors between years 1 and 2.
Who got to do the property inspection on that one?
Actually, when we first identified it, I sent Vicky, who's my property supervisor, out there with her daughter saying, here, go for the weekend and go out there and take a look at it. And she looked at it and said, yeah, love it. So then I flew out there and took a look at it.
And how are you guys going to manage the asset from a distance?
Well, we have a management company out there that we're hiring so that they can take care of it because somebody has to be there to do the leasing and day-to-day management. We'll also have a handyman that can go ahead and take care of whatever extra work is there. I'm going to add to that real quick.
Okay.
Here's a fun thing about that. These 10 units, I'm going to take one of the units and I'm going to lease it myself.
Okay.
And that way I have a unit there in Hawaii to be at. Well, all my investors, I'm giving them use of that unit while they're there. So they'll have a car there to use. They'll have an apartment there. And depending on, obviously check with your CPA, most of that is tax deductible because you're going to check on your investment.
All right, fantastic.
Well, good. We'll see. So, kind of wrap it up here with some more macro type questions here. You've been in the business for a little bit, as we talked about. What are some of the differences in today's markets versus over the you've been in the business for 25, 30 years now. So, what's kind of the differences today? I mean, obviously, you started out back in the 80s. Late 80s, early 90s when the RTC, Resolution Trust Corporation, was out there and the big S&L crisis. So today's environment's materially different than them. So maybe kind of compare and contrast. And what are some of the special challenges in today's environment?
I would actually say that when we were buying in the early 90s from the RTC, that market then was worse than the 2008 crash. 2008, that was national. The RTC days, there was so much overbuilding in DFW that we were buying Class A properties, 5-6-year-old properties at $20,000 a door.
Right. Yeah.
And the government did not make the same mistake during this crash in 2008, which I was hoping they would so that we could pick up some great deals. But everything's cyclical. The market's going to go up and down. And we are in a very, very hot market in Dallas. And a lot of money chasing a lot of deals. Cap rates getting compressed, values going up, rents are going up. And nationally, we're probably at the top of the market or close to the top of the market. But Dallas-Fort Worth still has 3 years. The next 3 years, we still have, 3 or 4 Fortune 500 companies moving to Dallas-Fort Worth and all the ancillary businesses that are going to come with that. So I think that Dallas-Fort Worth is extremely strong. They've got great fundamentals. So I think they're poised for a lot of growth.
What's your biggest challenge right now when you're out there trying to buy a property? Just competition, lack of inventory? What's
competition? It's getting ridiculous. When a property goes to market, they actually go through and do the best and final and all this other stuff. The brokers have you bidding against yourself.
Yeah, it's ridiculous. Yeah,
it's absolutely ridiculous. and stupid money chases deals, or 1031 money that they know they have to buy something, and they'll put up hard money into a transaction. Hard money day one saying, hey, you can have this whether I buy it or not. Yeah. And sometimes I do that just to get in the game, put my own money up and do that just to make sure that I can get it. But I try and avoid that. But I'm seeing something a little bit interesting now. Sellers are not really listing as much, because they don't need the mass exposure that they needed in the past. Now everything's a quote unquote off market deal, and all they do is float it out to a few people and it goes out like crazy, and they save some extra commission and they still get as much demand and bids on it as they used to.
So how's the environment for raising capital today versus back in 2008, 2009? How much easier or difficult is it today to get investors than, say, 2009 when you're out there buying deals?
Well, it's a lot easier. They realize that the market, they've been slammed by the stock market every 7 years, and they're saying, forget this, I need to get out, get into some real estate. And with values going up the way they have, they actually want to diversify and make more money in this. Now, there's so many ways why real estate is so much better than any other investment. We don't even have time to go through that. But with returns with IRRs in the mid-20s and getting 60% of your cash back within 2 years, mostly tax-free, you can't beat it.
So do you you own all these thousands of doors. Do you guys self-manage, or do you own a third property management company? Manage your units? I mean, why either way?
Well, like I mentioned earlier, we started and we had our own management company and we took care of those assets. And management takes a whole lot of different skill sets to take care of. I don't think any one person can do it. It really takes a team to go through and do that. And especially, well, let me rephrase, until you have 2,000 units under management, you really don't have the economies of scale to have the HR person you need, to have the different levels of management you need. So I do hire third-party management to go ahead and take care of all my assets because there's such a deep bench on that. The two principals of the management company that I use, they've got 75 years of experience between the two of them, and they ran over 100,000 units. So there's no way that I can compete with that myself. So definitely hire third party.
Okay. And then we're in DFW. Is there an area specifically? Is there a town that you like? Is there a town that you don't like? Tell me a little bit about, if you're buying, what areas do you like?
Every deal is good and every deal is bad. It all depends on the individual deal. There could be the greatest deal in Oak Cliff or the worst deal in Highland Park. It doesn't really matter because it's all in the property that you're buying. Now, when we buy, we know where we're going to make money. We go in there. You make money when you buy real estate. You only capture it when you sell it. And in that process, we go in there and look at every deal and say, how can this make money? How can we increase the value of this property? And the beautiful thing about this is we make money by improving communities. We actually improve communities and profit from it. So the cities like us, the residents like us. It's a beautiful business.
Yeah, you're doing all the improvements to the property up front. You're not trying to take it out of cash flow, So we give you rehab dollars to do all these windows or air conditioners or chiller systems or roof. We give you all the money up front. At least we try to give you as much money as possible. You still have to bring equity into the deal, but we give you as much money as we can. So you guys own thousands of doors and you have tenants and buildings. Any funny stories that people can relate to with your experience? Maybe one or two stories if you have.
Well, oh my God.
G-rated, yeah.
Yeah, G-rated. Okay. There are so many. Every time we talk about this on any property, everybody always says, there should be a sitcom on this because you can't write this stuff. Maybe it's PG-13. Sure. But we had a pest control. This is one of my favorite stories. Pest control guy came into the office and said, you need to go look at unit 123. And so the manager went out there and opened the door, went in there, and there was a man naked in a cage wearing a dog collar with a dog bowl in the cage. And she's like, oh my God, we need to call the police. And he said, no, don't let me out. Don't let me out. I want to be here. And, it's okay. And so you get things like that. We had another one where the FBI came to arrest somebody. Maybe it wasn't the FBI. Actually, that was a police department. Came to arrest somebody. And they kicked down the door, pulled their guns, threw the people down on the floor, and they kicked in the wrong door.
Yeah.
Just missed it by one number.
So there's all sorts of things.
And you guys also have a video out of some of these stories. What's your television show?
Okay, we actually filmed one of the properties I did. I said we can create $1 million in value on this property in 30 days. And I had people saying, oh, Bull, you can't do that. So I said, here, I'll film it to prove it. So I went through and hired a crew to go ahead and film everything. And so we filmed the entire process as far as everything we did. So that one is, we call it Purple Martians, and because it was really about changing the tenant profile, going on there with evictions and with people selling heroin, with everything else, to go ahead and really fix up a property, and had crews come in there on top of each other doing all of the rehab and everything that's there. Then we also did, on a different property, a 7-episode series. And those aren't for sale or anything like that. We've got DVDs of those, so if you want any of those, we can mail them to you. But we have those available.
That's great. Well, Darwin, we really appreciate your time today. If someone wants to reach out to you, what's the best way to get a hold of you?
Actually, we've got an email address, invest@darwingerman.com, and that will go to our entire team. And that way, anybody who's relevant to whatever the question is can reply. But that's invest@darwingerman.com.
Darwin, we really appreciate your time. Paul?
Yep, we appreciate you being a good customer. Keep on being a good customer of Old Capital. We appreciate it. And then thanks for spending some time with us in the podcast. We appreciate it.
All right, thank you.
Thanks.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.